Hey everyone, and you know how much I love talking about building wealth, right? Well, one of the absolute keys to growing your money is understanding where to put it in the first place. It's not just about picking the hot stock tip of the day, it's about creating a solid foundation for your investments. That's where asset classes come in. They're like the building blocks of your financial future. Think of it like this. You wouldn't build a house using only bricks, right? You'd need wood, concrete, maybe some steel, a mix of materials to make it strong and resilient. Same goes for your investments. Just like you wouldn't put all your eggs in one basket, you shouldn't put all your money into just one type of investment. You need different asset classes to spread your risk and increase your chances of success. In this video, we're diving deep into the world of asset classes. We'll break down what they are, why they matter so much, and how you can use them to build a rock-solid investment portfolio. Whether you're just starting out or you've been investing for a while, this video is packed with valuable information that can help you make smarter financial decisions. So, let's get started. Before we jump into the specifics, let's make sure we're on the same page about what asset classes actually are. In the simplest terms, an asset class is just a fancy way of saying a group of investments that behave similarly. It's like categorizing your groceries. You've got your fruits, vegetables, dairy, and so on. Each group has its own characteristics, and just like you wouldn't expect an apple to taste like a carrot, you shouldn't expect all investments to behave the same way. Now, within each asset class, you'll find individual investments. Think of stocks, for example. Stocks are a type of asset class that represents ownership in publicly traded companies. Within the stock asset class, you have individual stocks like Apple, Tesla, or Amazon. Each of these companies is different, but they all fall under the umbrella of stocks. The cool thing about asset classes is that they tend to perform differently under various market conditions. For instance, when the economy is booming, stocks might skyrocket in value. But when things get rough and the economy takes a hit, bonds, which are generally considered less risky, might hold their value better. Okay, let's break down some of the most common asset classes you'll come across on your investment journey. First up, we've got stocks, also known as equities. Stocks represent ownership in publicly traded companies. When you buy a stock, you're essentially buying a tiny piece of that company. Now, stocks are known for their potential for high returns, but with that potential comes higher risk. The stock market can be volatile, meaning prices can go up and down quickly. But over the long term, stocks have historically outperformed other asset classes, making them a popular choice for growth-oriented investors. Next, we have bonds. Bonds are a bit like IOUs issued by companies or governments. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the promise of getting your principal back when the bond matures. Bonds are generally considered less risky than stocks and can provide a steady stream of income. Then there's cash and cash equivalents. This category includes your savings accounts, checking accounts, money market accounts, and things like certificates of deposit, CDs. These are your super safe and liquid options. They're great for short-term goals or emergencies, but they don't typically offer high returns. Real estate is another popular asset class. This includes residential, commercial, and even land. Real estate can provide rental income and the potential for appreciation, meaning the value of the property could increase over time. Alright, so we've covered the basics of asset classes, but you might still be wondering, why should I even care about this stuff? Well, understanding asset classes is crucial for one major reason. It empowers you to make smarter investment decisions. Let's face it, the world of investing can feel like a jungle sometimes, with all sorts of financial predators lurking around every corner. But when you understand asset classes, it's like you're suddenly equipped with a map, a compass, and a whole lot of bug spray. You're better prepared to navigate the terrain and come out on top. The first big reason asset classes matter is diversification. We touched on this earlier, but it's so important that it's worth repeating. Think of diversification as not putting all your eggs in one basket. If one basket falls, you haven't lost everything. By spreading your investments across different asset classes, you're reducing the risk of being wiped out by a single market downturn. Ready to build your investment portfolio? Consider these crucial factors. First, figure out your risk tolerance. How much risk can you handle? Next, think about your time horizon. How long will you invest? Short-term goals need conservative investments. Long-term goals can handle more risk. Align your asset allocation with your financial goals. Now, let's talk about one of the most important concepts in investing: asset allocation. In simple terms, asset allocation is just a fancy way of saying deciding how much of your money to put into each asset class. It's like creating a recipe for your investment portfolio, with each asset class representing a different ingredient. Too much of one ingredient, and you might end up with a dish that's too spicy, too bland, or just plain inedible. The same goes for your investments. The right asset allocation can make all the difference. Here's the thing. There's no one-size-fits-all approach to asset allocation. The ideal mix for you will depend on those factors we talked about earlier: your risk tolerance, time horizon, and financial goals. But to give you an idea, let's look at a couple of examples. Let's say you're a young investor with a long time horizon and a high risk tolerance. You're comfortable with some volatility in your portfolio because you're in it for the long haul. In this case, you might choose a more aggressive asset allocation with a larger percentage of your portfolio in stocks, which have the potential for higher returns over time. You might allocate, for example, 70% to stocks, 20% to bonds, and 10% to cash. Now let's say you're closer to retirement and have a lower risk tolerance. Let's talk about some common mistakes to avoid with asset classes. Don't put all your eggs in one basket. Diversification is crucial. Betting on one investment is risky. If it fails, the outcome won't be pretty. Spread your investments to reduce risk. Don't forget about inflation. Inflation erodes your money's value. Ensure returns outpace inflation. Invest in assets like stocks or real estate. Don't let emotions drive decisions. Avoid hype and panic. Emotional decisions lead to disaster. Investing is a marathon, not a sprint. Stick to your plan for long-term success. Alright, let's shift gears and talk about how to actually put all this knowledge into practice. Building an investment portfolio might seem intimidating, but it doesn't have to be. Here's a step-by-step guide to get you started. First things first, get clear on your goals. What are you saving for? Retirement? A down payment on a house? Your dream trip around the world? Having specific goals will not only keep you motivated but will also help you determine the right investment strategy. Once you know what you're saving for, it's time to do your research and choose the asset classes that align with your goals, risk tolerance, and time horizon. Remember, diversification is key, so don't put all your eggs in one basket. Now, if you're just starting out, you don't need to go out and buy individual stocks or bonds right away. In fact, it's often a good idea to start with something simple and easy to manage, like a diversified mutual fund or exchange-traded fund, ETF. These funds pool money from multiple investors to invest in a basket of assets, which provides instant diversification. Awesome! We've covered a ton of ground today, exploring the world of asset classes and how they can help you build a solid foundation for your financial future. Let's recap the key takeaways. First, we learned that asset classes are like categories for investments, grouping together those that share similar characteristics and behaviors in the market. We talked about stocks, bonds, real estate, gold, and even those more adventurous alternative investments. Second, we dove into why understanding asset classes is so crucial. It all boils down to diversification, spreading your risk and not putting all your eggs in one basket. We explored how different asset classes react differently to market conditions, allowing you to strategically manage risk and hopefully maximize returns over the long haul. And finally, we emphasized the importance of aligning your asset mix with your own personal circumstances. Your goals, risk tolerance, and time horizon all play a role in determining the ideal blend of asset classes for your portfolio. Remember, investing isn't a one-size-fits-all game. And there you have it. You've just taken a crash course on understanding asset classes. I hope you found this video helpful and feel more confident about taking control of your investments. Remember, building wealth takes time and effort, but by understanding the basics of asset allocation and diversification, you're already ahead of the game. The most important thing is to start investing as early as possible, even if it's just a small amount. The power of compound interest is real, and the sooner you start, the more time your money has to grow. So, what are you waiting for? Take that first step towards building a brighter financial future today. Thanks for watching, and I'll see you in the next video. Understanding asset classes is the first step to becoming a smarter investor. By diversifying and making informed choices, you can create a portfolio that works for you. Start your journey today. Your future self will thank you. Found this video helpful? Hit the like button, subscribe to the channel, and share it with someone who's just starting their investment journey. Let's grow wealth together.